What's up, YouTube? Welcome. It's your boy Double L Deloitte, and today I'll be sharing this video with y'all. So stay tuned, subscribe, like, and leave a comment down below. Without wasting any of your guys' time, let's get to it. So today I'll be sharing a trade idea with y'all, and I hope you could pick up a thing or two. You see, I am not a financial advisor, and this video is for educational purpose only, so please don't come at me in the comment section. Without any further ado, let's get into the video. So basically I'll be sharing with you guys my knowledge of my market structure. So basically the market moves mainly in two directions, either up or down. It's either we're bullish or we are bearish. That's it. So here on the screen is an illustration of what I am talking about. So on our left we could see an example, simple market structure of a bullish structure. So what's going on here is that price is moving from a lower perspective to a higher perspective, creating a higher low, higher high, higher low, higher high, break of structure to confirm these 2 points, higher low, higher high, another break of structure, higher low, and then higher high. So basically this is what happens on a bullish trend, bullish market. We're creating higher lows and higher highs, confirming those higher lows and higher highs by breaks of structure. So on the right hand side we have ourselves a simple perfect example of a bearish market structure. See, okay, so what's going on here is that we have a lower high, lower low, lower high, lower low, break of structure. This low is lower than this low, that's why we say it's a lower low, and this one is higher than this low, that's why we call it a higher low. Lower low, lower high, lower low, lower high, lower low, lower high, lower low. We have breaks of structures to confirm that indeed we are having lower lows, lower highs, higher highs, and higher lows. So basically guys, what you see here is a very simple example of how market structure is, but unfortunately as traders, price doesn't really represent the trend as simple as you see here, but I just wanted to use this as an example so you grasp the subject, what we are going on about. So I also have an example of how market structure is looking. So down here, this is a much noisier, less cleaner structure formation. See, so here nothing's different, but it's just more detailed than the previous example. So we still have we'll start with the bullish trend first. We have a lower high, a higher low, sorry, a higher high, a higher low, and then a higher high. For me, how I distinguish that we are in this range is that you see I take a rectangle from the instruments, I draw from my lower high, my higher low to my lower, my higher high, and then I drag my rectangular drawing across until either I break up or down from this range, this trading range. So anything that's within this trading range is just noise. You just ignore what's going on here. Not really ignore, but for us to be accurate in determining that we broke structure, created new low and a new high, we have to break out of this trading range. See, okay, so right, after we've broken out of this trading range, we've created this low, we've confirmed, I mean, this low, and then made a new higher high, and then price moves back down. Price doesn't move in one direction, so you know it always moves up and down, sometimes sideways. We call that a consolidation. Yeah, so cool. Once price forms this high, we retrace back and form this low, mitigating an area of interest right here, and then price moves away from this area of interest. This is a place where we would anticipate to take trades from. See, okay, simple. After we've broken this high, confirming this low, we create a new higher high, and then price retraces back into this trading range to mitigate an area of interest right here. See, we've mitigated an area of interest within this trading range, you see. And then price, after mitigating this trading range, we broke structure, confirming this low. This low is lower than this one, so we can't use this one as our lower low. This is internal structure right here. We are looking at the swing points of the structure. So after price created this low, it moves away from the area of interest and then breaks structure to create a new high. So okay, cool, we've done with the bullish market structure example. See, now we get into the bearish market structure example. Right here, as you can see, what's going on here is actually the opposite of what happened here. Instead of moving upwards, price is moving downwards. See, okay, let's go. Price forms lower high, lower low, lower high, lower low, lower high, lower low, lower high, and lower low. So what's going on here is simple, guys. Price mitigated a point of interest within this trading range, moved away, broke structure, confirming this lower high, making this lower low, and then price retraced back into this trading range to mitigate an area of interest, and then after mitigating the area of interest, price distributed to the downside, broke structure, created this low, retraced back into this trading range, and price mitigated another point of interest within this trading range. And then after mitigating the area of interest, price distributed again to the downside, broke structure, creating this low and this high. So it's as simple as that, guys. This is how structure forms in the market. So structure doesn't actually move in one direction. For us to know that structure is changing from bullish market structure to bearish market structure, we get a change of character somewhere along the trend, right? So yeah, I also have an example of that illustrated down here. So as we can see, I'll be a bit fast. We have higher low, higher high, higher low, break of structure, higher high, retracement back into the trading range, mitigation of an area of interest somewhere down here, creating higher low, distributing to the upside, breaking structure, creating this higher high, retracing back into the trading range. Guys, price always comes back to areas of interest okay, let me not say always, but most of the time it does come back to your areas of interest if you accurately um, point them out. So you have to have knowledge of all these things. So yeah, with that, let's get back into it. After forming this high, price came back, mitigated an area of interest somewhere here, formed a lower low. XNS, what do they want? Formed a lower low, broke structure, formed, a higher low, broke structure, formed a higher high, and then what you would think is that price came down, formed a higher low, and then a lower low, a lower high, but you'd be actually distinguishing it the wrong way. So how you would go about this scenario right here, where we have a change of character from a bullish trend to a bearish trend, is simply by, you remember when I said identifying our trading range using a rectangular instrument, right? After price breaks out of the rectangular instrument, that's when you confirm your break of structure, right? Okay, simple. I'd advise that you do that all the time you get a trading range. You draw the rectangular structure so that you can confirm whether price breaks up or down. So in this scenario, you would have taken your rectangular instrument, drawn it from the high to the low, and then across. And then what you would do is that we would anticipate that price could have broken structure up here, right? After coming down into this trading range, mitigating a point, it would break structure to the upside. But no, price didn't do that. Price reversed, um, taking out this low, right? Confirming our change of character. Not this low. This low can't be considered as a change of character, because why? We are still inside the trading range. Everything that is inside the trading range is invalid is not valid to confirm our change of character and break of structures. We need to break the swing, either the swing high or the swing low. See? Okay, sorry. So what happened here is that we broke below this low, forming a change of character. What does that mean? It means that our direction now changes from bullish to bearish, changes from up to down. We're no longer moving up, but now we are getting ready to move what? Down. So what happens is that along this area, price left an area of interest whereby it came back to mitigate. Price formed this high and then came to form this lower low, and then coming back, mitigating this area of interest, forming a lower high, breaking structure to confirm this lower high, moving to form a lower low. So yeah guys, that's mostly it for market structure, right? So we will move into the live market so that you can see an example of what I am talking about, yeah? So it's really not that hard. See, some people may think it's hard, but actually it's just having the adequate knowledge to be able to correctly identify areas of interest, market structure, so that you can be on the right side of the market. So yeah, so what happens here is that we have this low right here, price moves up, we form this high, we come down, form this low, we move up, form this high, form this low. You get it guys? So basically right here we are breaking structures, right? Breaking structure, that's all we're doing. We're breaking structure right here guys. Sorry about that, I can't sing right now. After we broke structure here, okay, after we broke structure here, we moved and then created, okay, remember the rectangular instrument idea is that, sorry, we were here, from here to this high, we take our rectangular instrument, we drag it across, we find out that no, we broke structure up here. See, cool. Then we form our lower, this is our lowest low within this trading range, right, before breaking structure. And then what happens is that price forms a new high, right? Price retraces back into the trading range, forms a higher low, right? Simple. And then price breaks, sorry about that, guys. Price breaks this high, confirming this low, to create this new high, to create this new low, to create this new high. And then what happens after forming this high, price is expected to come down here, retrace into this area, mitigate a point of interest, and then move up. But price did not do that. Remember, as our box is drawn like this, price was supposed to come back into the trading range, mitigate an area of interest somewhere here, and then move back up to break, but it did not. But price broke to the downside, so meaning that we are getting ready for a bearish market direction. See, so as simple as it is, that's how we go about identifying market structure. I hope this video helped you guys. Please leave a like, comment on what you would like me to explain next, and don't forget to subscribe, guys, as it will help me along the future. Thank you very much.